Now we come to the intra-group transaction for the property, plant and equipment. Similar to the intra-group transaction for the inventory, any intra-group sales of property, plant and equipment should not be regarded as sales. So therefore, we try to reinstate everything to the original carrying amount. So any gain on disposal of the property, plant and equipment should be eliminated on consolidation. One further complication is higher value will attract higher depreciation. Therefore, after the intra-group sales of the property, plant and equipment, we may have over-depreciated the plant, and therefore, on subsequent depreciation, there should be an adjustment to the depreciation as well. And again, there will be a deferred tax implication on these kind of consolidation adjustments. Following the same assumption under the intra-group sales of inventory, we assume that if this is a sales from the parent, there will not be any impact on the non-controlling interest on consolidation. If this is a sale from a subsidiary, we will ask the non-controlling interest of that subsidiary to share part of the adjustments. So if this is a sales from the subsidiary 1 to subsidiary 2, we ask the non-controlling interest of subsidiary 1 to share. If this is a sales from the subsidiary to the parent, we will ask the non-controlling interest of the subsidiary to share part of the consolidation adjustments. But if this is a sales from the parent, we will not adjust the non-controlling interest on consolidation. Take this as an example. P controls 90% of the subsidiary, and on 1st of January 2002, P sold equipment to S for $360,000. So the original cost of the equipment was $400,000. When we purchased it on 1st of January 2000, on that day, it was $400,000. The remaining useful life was 10 years from the original purchase day. So the purchase day was 1st of January 2000. Therefore, at the day of the intra-group transaction, it was 2 years old. And therefore, the remaining useful life is 8 years from the day of the transfer, assuming a tax rate of 20%. So we understand that P sold the equipment to S for $360,000. So in the financial statement of the parent, they think that they must have received money, $360,000. So they have debited bank $360,000. They think that they have sold the equipment, therefore they have already credited away this $400,000. So they credit equipment $400,000. It was 2 years old, so 2 years has been depreciated. So $400,000 depreciated over 10 years, that means $40,000 per year. 2-year depreciation means there should be a accumulated depreciation of $80,000. Accumulated depreciation is a credit, so to eliminate, we debit accumulated depreciation $80,000. What does that mean? This means $400,000 original cost, 2 years has been depreciated, so the net book value of the disposal is $320. So from the viewpoint of the parent, they think that they successfully sell something which have got a net book value of $320 for $360. Therefore, they have got a gain on disposal of $40,000. This is 100% correct in the financial statement of the parent. In the financial statement of the subsidiary, financial statements of the subsidiary think that they have got an equipment $360,000 and they pay $360,000. This is again correct. On consolidation, we have to eliminate all intra-group transaction. There should not be any intra-group transaction. So we have to restate everything to the original cost. So on consolidation, the first thing that we must eliminate will be this gain on disposal. So therefore, we debit gain on disposal. we debit away this gain on disposal. There should not be any intra-group sales, and therefore there should not be any gain on disposal because we did not sell it to outside party. We have to reinstate the equipment. Now after the transaction, we think that the equipment will be 360,000, but the original cost of the equipment should be 400,000. Therefore, we debit equipment 40 to bring the equipment from 360 back to 400,000. We have to reinstate also the accumulated depreciation. So therefore, we credit accumulated depreciation. After these adjustments, the equipment cost reinstated to 400,000. Accumulated depreciation reinstated to 80,000. So the net book value is 320,000, as if there's no intra-group transaction at all. And the gain that the parent has recognized has been eliminated. So therefore, everything has been reinstated as if there's no transaction at all. On consolidation, no intra-group transaction. One further complication is, for this consolidation adjustment, is a consolidation adjustment. In the financial statement of the parent, this gain on sales is really a gain on sales. So tax will be charged if it is chargeable to tax. Therefore, there will be a temporary difference, and we have to adjust for the deferred tax. So we debit gain on disposal, therefore 20% tax rate, we credit tax expense. On a net basis, you have credited the net book value of the asset, so the assets value go down. So when the assets value go down, deferred tax asset, 20% tax rate. Not only we have to adjust for the gain on disposal, we notice that actually this intra-group transactions occurs on the very first day of the year of the current year. Therefore, 1 year has been depreciated. 1 year has been depreciated. Originally, the depreciation should be 400,000. 400,000 depreciated over 10 years. This means 40,000 every year. Now, because of the transaction, the value has been overstated to 360,000. And this 360,000 will be depreciated over the remaining 8 years. That means 45. So therefore, the subsidiary in its own book must have over depreciated by 5,000. So we have to eliminate this over depreciation. Therefore, on consolidations, we credit depreciation. Depreciation should be only 40,000 if there's no transaction at all. Now you have depreciated at 45. So you over depreciated by 5,000. So we credit depreciation 5,000 and we debit accumulated depreciation. Again, there's a deferred tax implication because you credit depreciations, we debit tax expense. Because you debit accumulated depreciation, that means gradually we are reversing this deferred tax asset. So this deferred tax asset should be gradually reversed over its remaining useful life, 8 years. So therefore 1 year is credit deferred tax 1,000. So in 8 years time, all the original deferred tax assets will be reversed. So this is what we have done in the year of the transaction, year 2002. So we have done 4 journal entry. Now assuming that this is 8 years after the transfer, 8 years already. So this is 8 years after the transfer. So we have already collected the new financial statement from the parent and the new financial statement from the subsidiary. Neither the parent nor the subsidiary has put through this journal entry. So therefore, after I get a new financial statement from the parent and the new financial statement from the subsidiary 8 years after, in 2010, we as a consolidation accountant have to repeat this journal entry. For the first one, 8 years before, it was a gain on disposal. Now we debit retained earnings. 8 years before, it was a tax expense. Now we credit retained earnings. 8 years before, it was a depreciation. Now we credit retained earnings. But depreciation we have adjusted every year. So therefore, there has been a credit to the depreciation for 7 years in the past. Why? Because we have over depreciated for 7 years. Therefore, we adjusted for 7 years already. And this is for the current year. Altogether, we have adjusted for the over depreciation for 8 years. The same for the tax expense, 7 years in the past. So we debit retained earnings 7,000 in the past. And we debit tax expense for the current year. This is to repeat what we have done and adjust for the additional depreciation that we have adjusted. This is the 8 years after the day of the transfer. Actually, this is the end of the useful life of the asset already. So strictly speaking, next year, we don't need to repeat this journal entry because the useful life of this property, plant and equipment is ended. So we don't need to repeat this journal entry because the net effect of this journal entry is 0. You can see that here we debit retained earnings 40,000. Next year, we will credit retained earnings 40,000 here. We credit retained earnings 8,000 here. Next year, we will debit retained earnings 8,000 here. So therefore, the net effect on the retained earnings is 0. So even we don't repeat this journal entry, we will not affect the reconciliation of the retained earnings. Now we come to the upstream transfer. If we use the same details as what we have for the downstream transfer, the only difference is this time is the sales from the subsidiary to the parent. So therefore, in the subsidiary's own book, they recognize the gain on disposal. And in the parent's own book, they recognize the equipment. So no matter this is a sale from the parent to the subsidiary or subsidiary to the parent, this kind of intra-group transaction must be eliminated. Therefore, on consolidation, we will debit away this gain on disposal. So we debit away the gain on disposal. We reinstate the equipment. Therefore, we debit equipment. Original cost 400,000. Now you state it at 360. So we debit equipment to bring it back from 360 to 400. And then we reinstate the accumulated depreciation 80,000 with a related deferred tax implication. You can notice that this adjustment is exactly the same as what we have done for the downstream transaction. Exactly the same. The same even for the depreciation. Originally, the depreciation should be 40,000. Now you depreciate it for 45. Therefore, there's an over depreciation. So therefore, we credit depreciations and we debit accumulated depreciation with a related deferred tax implication. Again, this is the same as what we have done for the downstream sales. It's exactly the same. What is different is because this time it is the subsidiary which sell the equipment to the parent, we will ask the non-controlling interest of this subsidiary to share part of the adjustments. We have made 4 adjustments. Journal number 1, we debit gain on disposal. If we debit gain on disposal, that means on consolidation, we think that the profit should go down. So starting from the subsidiary's reported profit, the subsidiary has reported a profit of 500,000. Certainly this 500,000 has included this gain on disposal. So on consolidation, we debit gain on disposal with a related credit to the tax expense. because of the deferred tax implication. We credit tax expense, therefore the profit should go up. So this is the effect for the intra-group gain on disposal. Not only the gain on disposal, but also there has been adjustment for the over depreciation. So we credit depreciation here, therefore profit should go up. When we credit this depreciation, there has been a related tax expense debit because of the deferred tax implication. So we debit. So on a net basis, profit should go up by 4,000 because of these adjustments to over depreciation. So overall, after the adjustments, the adjusted profit should be 472,000. 10% goes to NCI. Therefore, we debit profit to NCI and credit NCI. We need to do all these 4 adjustments because this is a sales from the subsidiary to parent. If this is a sales from parent to subsidiary, no adjustments to the NCI at all. Okay, so this is the adjustments that we have made in 2002. Now, if this is 1 year after 2003, so after I collect the new financial statement from the parent and the subsidiary, I, being the consolidation accountant, I have to repeat this journal entry. So to repeat, last year it was a gain on disposal. Therefore, this year we should debit retained earnings. But if we only debit retained earnings, that means we ask the parent to share all the adjustments. Actually, this is a 90% subsidiary, and this is a sales from the subsidiary, so that's why we ask the non-controlling interest 10% to share. So therefore, we debit retained earnings 90% of the 40,000. We debit non-controlling interest 10%. So this is the adjustments we share between parent and non-controlling interest. The same for the tax expense, 8,000. Last year it was a tax expense. This year this is a retained earning. So we don't simply credit retained earnings 8,000. So 90% goes to parent, 10% goes to NCI. The same for the depreciation. So we credit depreciation. This is for current year, but we need to credit depreciation for the last year. That means retained earnings. So we credit retained earnings 90%, 10% goes to NCI. For tax expense, this is for current year, and for last year we need to repeat it. So we debit retained earnings 90% and we debit NCI 10%. This is to repeat what we have done last year. And then we share the profit to NCI. So this is 2003, right? This is 2003. So last year was 500,000. Last year was 500,000. So we start from this 500,000. Because we have already adjusted the sharing of the adjustments to NCI and retained earnings in each individual journal entry, and therefore here we don't need to adjust. So we simply share 10% of the 50,000. If we did not adjust in the individual journal entry, that means if you simply debit retained earnings 40,000 and credit retained earnings 8,000 here, then here we have to adjust for these 4 adjustments, right? And then these figures will be 47,200. But as I've said before, I recommend you to share between the parent and the non-controlling interest in the individual journal entry. So if we have already shared between the parent and the non-controlling interest in each individual journal entry, then here no adjustment at all. Only 10% of the retained earnings. So we debit retained earnings and credit NCI. For the current year profit, we cannot share in the individual journal entry because of the structure of our consolidated income statements. So all sales, cost of sales, depreciation, etc. is 100% of the parent and 100% of the subsidiary. We don't share the subsidiaries' sales, etc. 90%, 10%. Therefore here, we start from the 800,000, which is only the reported profit for the current year. So the subsidiary has reported a profit of 800,000. During the current year, we have made 4 adjustments. Journal number 1 and journal number 2 has no impact on the current year profit. Journal number 3, we credited depreciation. Therefore, here the profits should go up. Crediting depreciation means profits should go up with a related debit to the tax expense. So therefore, the net adjustment is 4,000. So altogether, the profit should go up by 4,000 and NCI share 10%. The profit go up because of the adjustments of the over depreciation, because in the financial statement of the subsidiary, right, we have to adjust for these adjustments. So we debit profit to NCI 80,400 and we credit NCI 80,400. So these adjustments will affect the non-controlling interest. Therefore, when we adjust for the non-controlling interest, remember to adjust all this.